So on August 19th, the building materials giant James Hardie dropped its first quarter earnings. And what happened next? Well, it was one of the most brutal single-day sell-offs we've seen in a long, long time. We're going to break down exactly what happened and, more importantly, why.
Yeah, you're seeing that right. In just 24 hours after that earnings call, the stock absolutely cratered, down over 34%, a stunning collapse that just wiped out billions in market value. So the big question is, what on earth could possibly justify a reaction that severe?
And that's exactly what we're here to do. We're going to unpack that earnings report, decode what management is trying to do, and really get to the bottom of this massive disconnect that led to the market's brutal verdict.
All right, first things first. To really get what's going on here, we have to start with the headline numbers. And to put it simply, the quarter was a miss, a big one, right across the board.
Okay, let's just dig into the scale of this disappointment. Adjusted earnings per share missed by 6 cents. Revenue, it fell short by over $50 million. But, the really painful part is when you look year over year. Adjusted EBITDA was down a whopping 21%, and sales in their core business, North American fiber cement, just plummeted 12%. So yeah, this wasn't some slight miss. This was a massive red flag, a clear signal of some really serious underlying weakness.
So the immediate question is why, right? What caused such a sharp downturn? Well, on the earnings call, management pointed to one primary culprit.
CEO Aaron Err, he framed the issue as a normalization of channel inventories. Now that is some classic corporate speak, isn't it? What it really means is that their customers, the distributors and dealers, are cutting back on their orders because they see weaker demand coming down the pike.
And this slowdown is really happening on the ground. Repair and remodel activity is softening up as homeowners are starting to put off those big-ticket projects. New home construction, which is a huge driver for James Hardie, is getting weaker, especially down in the U.S. South. All of this basically forced their channel partners to just slam the brakes on new inventory orders, which directly hammered James Hardie's sales volumes.
But here's the thing. While the market was in a full-blown panic about the present, management was desperately trying to sell a story about the future. A future that is centered around their massive, transformative acquisition of Azek.
This whole acquisition is really about accelerating their core strategy, which they call material conversion. And the idea is pretty simple, actually. Convince builders and homeowners to ditch the traditional stuff like wood and vinyl and instead use James Hardie's premium fiber cement and, now, Azek's composite products.
The Azek deal is a huge bet on this strategy. I mean, it literally doubles their potential market. It pushes them into that very lucrative outdoor living space with decking and railings. But, and this is a big but, there's a catch. It also loads up their balance sheet with over $5 billion in debt right as the housing market is starting to look a little shaky.
Now, to justify taking on that much debt, management is promising huge synergies. They're targeting $125 million in cost savings over 3 years and an even more ambitious $500 million plus in commercial synergies from cross-selling products. They did note that they're ahead of schedule on some of the initial cost cutting. This is their path to making the whole deal work.
But despite management's laser focus on the future, the market just wasn't buying it. Not at all. Investors were completely fixated on the problems of today, and that created this massive disconnect.
And this really reveals that fundamental disconnect. On one side, you have management pitching this beautiful 5-year vision of synergies and market expansion. And on the other side, you've got investors staring at a disastrous current quarter, a sharply lowered forecast for the whole year, and a weak cash flow outlook, all in a high-debt environment. The market chose to believe the now.
And they expressed that belief with a lot of conviction. Just look at this spike in trading volume. 71 million shares changed hands the day after the call. That's about 10 times the daily average. This wasn't a slow drift down. This was a stampede for the exits.
So, this all sets the stage for our final analysis in the next call. What does all this chaos really mean for the stock going forward?
After a 34% haircut, investors are left asking themselves, is this a catastrophe or is it an opportunity? Where does the stock go from here? Our view is market perform. Essentially, what that means is we see the stock as pretty fairly valued right now. After that collapse, it's a balance of some pretty significant risks and, some potential long-term rewards.
This is a classic battle of timelines. The bull case is a long-term one. If they execute the Azek integration and the housing market eventually recovers, the upside could be massive. But the bear case is all about the next several quarters. The demand headwinds are severe, and the new guidance implies a full-year earnings number that's more than 40% below what analysts were expecting before.
This crisis of confidence is happening at the worst possible time, which is why we're justifying a neutral market perform rating for now.
And a final reminder, as always, this is not financial advice. Please be sure to do your own research.